Hi guys, welcome to another episode of Finance Talk, where we speak about finance, business, and investing. I'm Eugene. I have more than 10 years of experience in business. I also interested in finance and building my own portfolio and hoping to set up a fund in the nearest future.
And I'm Nick Rational. I too have a lot of business experience and been doing the investing for a while now. Together, we're going to share with you what we have learned, and together we can all learn more and become greater investors. I too hope to start a fund in the near future, and let's all learn together.
So, what will be our today's topic, Nick?
So I think a good topic to discuss is reasons not to purchase a company that are simple reasons, not big, going through a whole checklist and looking at 100 things, just little accidental things that you might want to think about avoiding. So, for example, a sin stock is a company that is morally in the gray area. It'll be your judgment if it's a sin stock or not. So a sin stock would be something that maybe makes the world slightly worse instead of slightly better. So things like cigarettes are a well-known sin stock. Some people would class marijuana stocks as sin stocks. Some people would not. Some people might even class Coca-Cola as a sin stock, and others would not. Guns, casinos, alcohol. Decide morally where you stand when you make your purchases, and a lot of companies will be just not an option for you if you think about the moral implications of owning the stock, because effectively you should be proud of what you own. If your children or grandchildren found out that you own that company, you don't have to own the whole company to be an owner. If you own one share or a quarter of a share or a tenth of a share, you're still saying, I own this company. I'm proud of what it does, where it is in the world. I want it to be around and bigger in 20 years than it is today. So think about what you're trying to say. Think about what you're putting into the world, and that's sort of something to consider. And that's in stocks. What are your thoughts on that?
Yeah, I definitely agree. But I think that this is more advanced stuff, and this is which type of investor you would like to be when you already have some money under management, or you have substantial amount of money which you consider enough. But I definitely agree with you that you need to be proud of what you are doing and what you own as stock as well.
As a final thought on this thought about sin stocks, I think it's not just for the advanced investor. I think it's for any investor, because it's not just about loving it. It's not just about being moral or doing the right thing. It's also being on the right side of history. If you make a mistake in choosing a company that is on the wrong side of history, you might suffer huge losses when the world catches up to realizing that this is a bad thing. So some people might say genetically modified foods are bad. At the moment, it's a gray area. But if you invest in a company that's massively into genetically modified food, and later it turns out that it was bad for you, and suddenly it's banned globally, it's already banned in 100 countries, that you can't even move the food through that country. It's banned so thoroughly. If you choose a company that ends up being on the wrong side of history, you will lose money, and we never want to lose money. So think about the future. What could change regulation-wise? What could be determined to be a bad and evil company that suddenly loses favor with the world? So I think that's definitely something to consider. The next one I'd like to discuss very briefly is it's a very complex formula that you don't need to know. You can simply put it into a screener tool or look it up in Google and type in the name of the company or the ticker symbol, and then you type in Altman Z-score, or you can put that into your screener tool. And the Altman Z-score does this complex mathematics, and the end result gives you a number. If that number is above 2.99, the company is in solid footing and safe from bankruptcy. If it's in the gray zone, that'll be between 2.99 and 1.81. It's a gray zone. But if it's under 1.81, statistically, the Altman Z-score has proved itself over 20 years and thousands of companies. If the score is lower than 1.81, it is an 80% chance of going bankrupt in the next 2 to 3 years. At least that's what I've read. And I tend to heed these kinds of things. I'm not going to buy a company with a low Altman Z score. And the closer you get to zero, the higher the chance of bankruptcy. What are your thoughts on that?
Yeah, this is a really great and interesting indicator. Personally, I do not think about this indicator until now. I will probably check this out and try to implement into the strategy. So basically, it's like the credit score for the individual. So the higher trust you have, the higher chances that you are a stable business and you are worth to do in business with. We as well investors need as much insurance as we mentioned in previous episodes as we possibly can. That's why we can also look for anomalies. For example, if the situation is not so well in the economy or something, a company stock is decreasing but the overall numbers are great, this particular score is also great. This can be considered as the insurance for you that this is the stable investment and you can make money on that.
Very similar to the Altman Z score is to discover, is the company you're thinking of investing in a zombie company? And this is an interesting term because a zombie is something that is or should be dead, and yet it is still alive. And that's the great definition of zombie companies. They should be dead, but for some reason they're still alive. Sometimes they get bailout after bailout. Sometimes they just make enough money to pay their debts, but not enough to pay down their debts. And so they're really on the edge all the time. So a zombie company is something you really don't want to invest in. As soon as the economy changes, it might go bankrupt. If other zombie companies fail, investors might pull out of your zombie company and the stock could plummet. There's a lot of reasons that a zombie company could just suddenly turn really bad. And how we filter for this is we put into the screener tools. Before we talk about the screener tools, roughly 16% out of the Russell 3000, which is the 3,000 fantastic companies, 16% are not so fantastic. 16% are zombie companies, something to watch out for. So how you find them is in the screener tool. You'll put in the first filter will be net debt divided by total capital, and then what you want is to put in greater than 25. And then you put in as the next screener interest coverage ratio, and you want that to be less than 1. And then you put in the EBITDA interest coverage ratio, and you want that to be less than 2. So it's only 3 filters, and it'll look through all the stocks, and it'll give you a list of the current zombies. And then you need to do a little search and check if your company is on that list, because if it is, that's a zombie, and you want to always avoid zombies. What are your thoughts, Eugene?
Yeah, this is a really interesting indicator. Personally, I also do not use it, but I use different metrics. But it is really important, I think, to know what don't do in order to understand what should you do as the value investor. The way I look at it is I look at the company as the human body. So when the human is healthy and has a lot of energy and all is great, you feeling well and you produce great results. Same is with the business. So when the company has healthy situation, it has lower debt, its revenue increasing, the management is great, and everything is fine, this will lead to greater results. And the first company, which, as you mentioned, can be like the zombie, AMC. So it's like the meme stock. It's unhealthy. There is a huge debt on this company. The company is on the down market because obviously less and less people attend cinemas around the world due to all the streaming services and online TV like Roku, Netflix, etc. They do not make any positive income, and they just continuing to burn money and take more debt. Of course, it's personal for everyone, but I try to stay away from these type of companies.
I think that many investors won't need to use the Altman Z score or look at the zombie companies method if they are. I mean, it's an extra way of being certain and being sure using those methods. But like, for example, a lot of investors will just look to see the debt to equity ratio or how many years of free cash flow would pay off the debt. And that's a much simpler way of doing it. And in my mind, I think that covers you a lot for the risks that are inherent in the zombie companies and also in the Altman Z score. But if you want to be certain, add these to your checklist, and you can be a little more certain of every investment. The more things on your checklist that are pertinent and will actually have an impact. You don't want to have a checklist of just absolutely everything that everyone has ever said. You want to kind of keep it tight and short, but find out which ones work the best for you, and add the ones that make sense to your checklist.
This is all for today. If you have any questions, please write them down in the comments below. We also invite you into the Discord group where we discuss different stock ideas, Guru Speaks. We do it every week and it's completely free of charge. So if you would like, you can always join us. You are welcome. Bye.